And we're off. We are live. It is June 9th, 2022. This is Cowboy Metal's live stream. Welcome everybody to the program. We'll give it a couple of minutes for people to load into the stream. Before we get started on the material, welcome everybody to the program. Looks like we got sound. Looks like everybody is here. Remember, super chats are open if you want to ask a question. That's the surest way to get a hold of my attention. And I'll try to answer some questions in the live chat as well. We have a poll up on this edition. The question is, experts agree that recession is around the corner. How bad will it be? You have four options. One is that a V-shaped recovery with a quick recovery, a double-shaped double dip plus a recovery, an extended stagflationary period, as some analysts have indicated they believe is going to happen, or an extended deep U-shaped long recovery, or a serious recession or depression. 16 votes so far. We'll read out those votes as we get further into the program. Title of today's presentation is Wall Street CFOs predict 2023 recession. Are they right? Are they correct? And that's what we're going to get into today on the live stream. Welcome everybody. Are they correct? Looks like sound is going, so we're going to go ahead and get started. I'll go ahead and do the share, and the title of this presentation comes from a CNBC story that got printed today. And the title of it is "A Recession Will Hit the First Half of 2023 and the Dow is Headed Lower, CNBC CFO Survey." So they looked at 22 CFOs as C-suite at top corporations, got the macroeconomic view of the CFOs, and they believe that we're going to have a recession in 2023. In fact, here are the percentages. 41% say the biggest risk factors facing their business is inflation, as we've been talking about now for a year and a half. 23% say it's the Fed policy, 14% say supply chain disruptions, and 9% the Ukraine war. This is according to the latest CNBC CFO Council survey. Over 40% of chief financial officers incite inflation as the number one external risk to their business. And going deeper into the results from the Q2 survey, the links between geopolitics, food, energy prices, inflation are clear from the C-suite. So everything that we've been saying on the program is what America's business leaders are worried about. CFOs are not uniformly of the view that the Fed won't ultimately be able to control inflation, meaning some do, some don't. 68% of CFOs responding to the survey, a recession will occur in the first half of 2023. No CFO forecast for a recession any later than the second half of next year, and no CFO thinks the economy will avoid a recession. So they're all pretty much saying we're going to get one. It goes on to note in this article that the 10-year Treasury, which has already doubled this year to roughly 3%, is expected to flirt with 4% by the end of this year, according to about 40% of the CFOs. An equal percentage of CFOs expect the 10-year rise to no higher than 3.49% by year end. That'd be another 41%. But on margin, there's concern about rates rising even more rapidly, with a few outliers in the council forecasting a 10-year that rises above 4%. And as I note here, the European Central Bank said Thursday it will raise rates for the first time in over a decade as its inflation outlook increased significantly. Of course, the European Central Bank has been issuing negative interest rate debt for quite some time. And the CNBC goes on to point out some of the issues. Growth prospects for the U.S. economy and global economy have dimmed. The Atlanta Federal Reserve's GDP Now tracker is forecasting a second consecutive quarter of negative growth, which meets the classic definition for a recession. While the World Bank just slashed its global growth outlook, warning that a period of stagflation like the 1970s is possible, and with its president David Malpass saying, for many countries, recession will be hard to avoid. How are we doing in the chat? Looks like everybody's in the house. Thank you, Peter Ferrine, for riding shotgun. As our moderator, Privateer is here, Duder Scooter is here, Neil Hahn is here as well. Thank you, everybody, for joining the program. The title of it is Wall Street CFOs Predict a 2023 Recession. Are they right? And on the last live stream this past Tuesday, I mentioned to you that I'll give you a preview of what's going on in the economy and where we are in terms of heading into the next big downtick or recession or depression. It's interesting in here that the article talks about a lot of things that we're going to go through today. And one of those has to do with interest rates and bonds. As the CNBC article noted, the bonds had doubled this year, the 10-year from about 1.5% to 3%. And so the Committee for a Responsible Federal Budget, crfb.org, is guesstimating how much a 50 basis point rise in interest rates will cost the government, how much 100 basis point or a percentage and 200 basis points. And they say here, if the interest rate are 50 basis points higher than projected, average annual interest costs would increase by 94 billion. It's actually not 940 billion. This is a misprint. If the rates are 180 basis points, 187 billion. Actually, I'm just going to look at these numbers here in the chart. With the current law, we're currently scheduled to pay 5.5 trillion in interest rates. If they went up 0.5%, you would add 937 billion to 6.4 trillion. If you add one interest rate point, it adds 1.9 trillion, and 2 interest rate points, 3.7 trillion. So that would vault total spending up to 9.2 trillion, which is almost double what it is, depending on where interest rates go. So interest rates do matter in terms of the bonds. And here's what that means. Higher interest cost means higher debt. So the debt would go up if we get a 2% in percentage point increase, the debt goes up 1% and 0.5%. You can see how it affects debt. So this is a pretty interesting study. Why do I talk about that? Because the bonds are the bellwether really for the economy. The last mortgage crisis, or the last recession crisis that we had, and banking crisis had to do with the mortgage market, had to do with the debt market. So the debt markets are extremely important. And I think in terms of the debt market, with the European Union raising interest rates for the first time in a decade, and this study here about how much additional debt we would take on to pay additional interest costs means that the Fed really can't raise rates that much. And if the rate on the 10-year bond continues to rise due to inflation and other concerns, it's going to really screw up our government, and they're going to have to bring out the helicopters. I wanted also to talk about some of the economic data that we've seen in the last week to give you an idea where things are going. So here we have home prices rise at new record rate, Case-Shiller shows, although it slowed down a bit. The Case-Shiller index rose 3.1% in March. A separate report, Federal Housing Agency shows a 1.5% monthly increase. Well, what does that mean? Housing is getting more expensive. At the same time, we just talked about what was rising, interest rates. So if you look at mortgage rates now on Google, their quick little chart, a 30-year fixed across the US is averaging over 6%, 15 years, 4.8%, a 10-6 ARM, 6.3% on a 300K loan, which is pretty modest in most metropolitan areas now. 300K really won't even get you a 3-2 starter home. But in any case, that the average American is going to want that has a family. In any case, over 6%, what happens to the affordability of houses? So how much longer are house prices going to rise before they have to retreat because of higher interest rates? Higher interest rates are damaging the public's ability to pay debt. Now we move on to manufacturing. ISM Manufacturing Survey Index shows stronger activity in May. So manufacturing has actually been up in May. It was up from an expected 55.4 to 56.1%. Anything over 50% is considered growth. So we do have growth in manufacturing, and that's pretty good. Although the S&P Global US Manufacturing PMI fell to 57. So we do have very positive growth in manufacturing over the last month, which is great. So we do have some manufacturing jobs working for us. And I think that's to heal some of the issues in the supply chain. US private sector job growth softens in May, ADP data shows. The data came out last week that private sector payrolls rose by 128,000, according to ADP, released Thursday. They forecast a gain of 299,000, so that was underwhelming. If you look at the unemployment, the government issued non-farm payroll report, we added 390,000 jobs in May, and economy seems to be doing well, except for the fact that if you look at the labor force participation rate, it's actually down. So the labor force participation rate as of right now is about 62.4%. Before the last recession, it was 65.8. So it's down 3 percentage points over that time. And in 2020, it fell down to 60.8. And then there were some hiring back. But all this hiring we've had since the pandemic hasn't gotten to where we were in 2020 before the pandemic, hasn't gotten to where we were before the last recession or before the last recession. So employment labor force participation rate wise has peaked in the year 2000. Then 2 recessions and the pandemic have brought that down to 62.4%, about a 5% decline. So it means 5% less people are able to find jobs. So even though the government's reporting healthy jobs, we've never gotten really back to where we were prior to the last big recession. And when people aren't working, they don't have money. When they don't have money, how are they going to afford both higher interest rates, which raise the servicing costs, and higher US home prices? At some point, that's got to break, and that's got to come back because there aren't enough people to buy it. And we're starting to see some softness in the real estate. The service sector is much bigger than manufacturing, however, so we want to look at that. And the services PMI drops to 55.9 from 57.1 in April. So the majority of the output of the GDP in the US is service-based and not manufacturing-based. So the manufacturing had a slight tick up. Overall, the economy is slowing down because this number has fallen, the ISM service PMI. And last but not least, the US consumer credit rockets to a new record high in April. So with regards to whether people can afford these higher house prices, higher auto prices, higher rent prices, higher everything costs, consumer credit has been rising. So it rose, I believe it was over 40 billion last month and then 38 billion this month, 3 billion more than expected. Right now it's sitting at a record 4.57 trillion in April. So consumers have more debt than they've ever had at a time when you have rising interest rates, less affordability, and higher inflation, and at a time when you're not going to find safety in bonds, and the government's going to be affected by how much additional costs that they have. So that's an overview really of where we are in the economy. So are we going to have a recession? I would say yes, if we're not already in one, given the fact that the government numbers are, to me, highly questionable. I do believe that we're probably already in a recession, but officially we'll probably get it this year if we have another quarter of a reduction in the GDP. And I think some of the data is showing that. The services data is showing that higher cost for people to buy things, people putting more stuff on credit, not having savings. When our savings rate is very low right now. I think that means we're headed to a recession because the consumer, which is 72% of the economy, can't drive it anymore. They're reaching the point of unaffordability on some things. And so things have to pull back and cool off a little bit. It's not just going to be a stock market sell off. The underlying economic data is not really strong. And the question is, do we have a recession this year or next year? I think it's definitely possible this year. How deep is a recession? That's the poll question that I put up. I don't think it's going to be a V-shaped recovery because I don't see where the Fed is going to be able to cut interest rates and fight the high inflation, or to fight the recession at the same time they're dealing with high inflation, and that wants to make them push up interest rates. A government can't handle the higher interest rates that they're getting as a result of inflation. So unless inflation magically goes away, which would require a recession, we're not going to have a V-shaped recovery. In other words, if we get into a recession, it's not going to solve the problems that we have, which are substantial and bigger than they were last time. And given the fact that labor is low and people are using credit and things like that, the consumers aren't going to lead the way. I would guess out of the 4 questions I put in the poll, I would say we would start with a stagflationary period, which I think we're already in, but then I think we go into a U-shape, deep recession with a long recovery eventually, because the stagflation is going to make things very difficult on the US government and on the consumer, and it's going to make it difficult on corporations that have rising debt costs. This is going to overall affect the ability of the economy to rise and to function. I think it's inevitable that we're going to have a recession. Sorry, guys, my battery in my PC is running low, so I had to get that plugged in. Yeah, I think it's almost impossible that we have any conditions for a growing economy. The only thing that did well was manufacturing was slightly up and slightly growing. And I think a lot of that has to do to meet it with pent-up demand. But if the consumers can stop demanding and the government and companies can't finance their debt because of high debt costs, not only the amount of debt they're carrying, but the exponential effects of rising interest rates really makes it difficult for there to be a quick recovery. The Fed can't reduce interest rates in the face of a recession. They're trying to raise them right now. They're stuck between a rock and a hard place. If they raise rates too fast and cool off the economy too fast, then they have to ease very quickly, and that just accelerates the issues with the US dollar and the debt system, and then you'll have a spike in inflation again. So I think they're between a rock and a hard place, and I think right now anything that the Fed does probably is going to make it worse. And I think, yes, for 100% sure, we're going to have a recession. I would guess it starts in 2022. I think it'll be a protracted one. I think you'll have stagflation. I think you'll have a recession. You'll have the Fed react to that. And there are going to be some rolling waves in there. And then eventually we're going to have some sort of debt collapse, although I think that is some time away. Dumb Money Media, thanks for the contribution. What does the CPI need to be for the market to have a bear rally? I think we're going to hit 9.5 before that. And will the CPI be recalibrated again? I think the CPI is recalibrated every month as they're trying to portray it being much lower than it is. I think the government CPI number is probably half of what the actual inflation rate is. what does the CPI need to be for a bear market, or for the market to have a bear rally? It needs to come down. I think it was like 8.2% last month. You'd have to see it come under 8 at least, but it would just be a bear market rally. It's not going to be an extended rally. It's not going to be like a V-shaped recovery for sure. Peter asked, low power, wait until the power blackouts this summer. Fun. Yeah, we're going to have power blackouts rolling across the country. That's been reported in the mainstream media. Texas, of course, is going to have issues because they put in too much wind and solar and didn't build out their nuclear. We are going to have 100-degree temperatures this weekend, Friday, Saturday, and Sunday, above 100 here in the North Texas area. Earlier in the year, probably about a month before it typically happens in Texas, month, maybe 5 weeks even. And we're going to be using record amounts of power. We actually use more power in Texas during the summer than we do in the winter, even when we have really cold winters. So that's going to definitely stress the grid for sure. I do not see any other questions in the chat. We're early for a Thursday, so not as many people are in, but I wanted to get another live stream in and give you the data that I'm seeing. All the data that I presented today was on the back of a report that I've been speaking at conferences and I put on the channel called Gold and Silver, Why This Time is Different, where I talk about the stock market correction that I said was going to occur and has occurred. I predicted that probably 3 or 4 or 5 months before it actually occurred, and where gold and silver are going to become more prominent. So what does this mean for gold and silver investments? I think the value of gold and silver is going to go up. I think that's very clear. I think silver is probably going to shoot up a lot more. There's a lot of pent-up demand for silver that you saw in the Tuesday's report in terms of the supply deficit. Gold, I think, will rise a little bit more gradually, but I think gold will definitely get more valuable as we go further in the system. It doesn't mean there won't be pullbacks, but I don't think that we're going to set 1,800 gold forever. I think we'll get 1,900, 2,000, maybe come back to 1,900, then go up, but it's going to stair step up. If we officially hit a recession, expect gold to take a huge rise as soon as that's announced, within 24 hours of that being announced. And also remember, per the Tuesday program, we talked about the Shanghai and the fact that gold has been trading up this year, which is different than the Western markets. And there's going to be additional pressure on the gold markets put by the Shanghai and now the French one that is about ready to open in the French gold trading window. I think we're going to put pressure on the Western prices as we go forward. Also, the inability, as I mentioned Tuesday, for the banks to comply with Basel III puts additional pressure on the system, which I think means some of the big financial interests will move over to gold, whether in a derivative or a physical format. So that is the data for the presentation tonight. I agree with the Wall Street CFOs that predict a 2023 recession. Are they right? I believe, in fact, that they will be correct. We'll hit a recession, although I think we're going to hit it in 2022 is my guess. And I have said this year we'll hit a 10% inflation rate print. I don't think the government wants it to go there. I don't see how it can't, because the producer price index has already hit double digits. In fact, I think at 11% at one point. And so I suspect very strongly that the CPI is going to have to come up, because the producers are just going to push their prices down to the consumers. Case in point, I went out to dinner again this week just to get some wings. Not too terribly expensive, but the wings are basically double what they were about a year ago. And there's less availability of the wings. A lot of times they have shortages, and prices are just up. They're up everywhere. And the restaurants are suffering. The restaurants in my area are closing right and left, and we're a pretty affluent area in a state that's doing very well, but the restaurant industry is still collapsing as we speak. And some of the restaurants have turned to basically not hiring wait staff, or hiring one wait staff for the entire floor, and having you do your own seating and having you have QR codes. Pretty soon, I think it's going to go to where you have a terminal at your table and you just type in what you want off the menu, and some busboy or somebody, bar back, brings the food to you at your table, but you don't even have an official server. I think that's probably what's going to happen in the restaurant industry. It's very obvious in the restaurant industry, the retail, and the office space that we're in an economic downturn. And it hasn't hit commercial or residential real estate yet, but I think it is. I think the data is showing that it's starting to turn over, although we do have a ways to go. But I think the data right now that we've gotten so far this month is definitely not terribly strong. And I think that agrees with the CFOs that we are going to have a recession for sure. And what other data do we have coming out? I think we have some more data coming out this month that you guys are going to want to pay attention to. The big one this Friday is a consumer price index. They're predicting it to be about 8.2%, which is the same, is a little bit less than last month. So economists believe inflation is going to come down. I'll go ahead and say this: if inflation is anything other than 8.5%, I think I'm just going to call BS on the government and say that they're blatantly lying on the number and don't even trust it anymore. Ralph Potts says $7.99 at the market. Rising prices. I'm assuming that is for meat. $7.99 a pound. Oh my goodness, I had like a $60 bill at the market the other day, and all I got were a couple of 6-packs of my stevia sodas, the sugar-free sodas that I now drink. And I got like a bar of chocolate and some pork rinds. I don't even know what else. It fit like in a little tiny basket with $60. I was like, oh my goodness. When I was growing up, $60 would have bought you an entire grocery cart full worth of goods. Looking for questions in the chat. We talk about what might happen to gold and silver with a probable stock crash. So if the stocks crash, gold and silver are going to go up. Now, gold and silver equities may pull back at first. Gold itself may pull back a little bit at first, because usually what happens in a stock crash is a liquidity event. People exit out of all sorts of derivative positions, including the spot market in gold, not necessarily the physical market, just the spot market that determines price, or the futures market that determines spot price, if I say that correctly. But I do think that gold and silver would rise strongly. In fact, if we get, with the stock market correction we've had, and the Bitcoin and the crypto crash that we've had, and the issues in the bond market, if we get into a recession, I think what happens next is the real estate market pulls back, and then gold and silver will shoot up as people fly to safety. So I think that's entirely possible. Could happen this year, maybe early next year. But I think the CFOs are right. I mean, they got the boots to the ground. They run the businesses. They know what's going on. And that's why this is such a influential and important report that we have to talk about. The CFOs know what's going on. They see the costs. They see the issues with the supply chain. They see the issues with their sales. They run these companies. They get the reports every month about what's going on. They know that we're headed to a recession if we're not already in one. And I think given the fact the government numbers are basically BS, I think it's safe to say we're definitely in a recession right now. What are your thoughts? Last check of the poll, 44 votes. 11% say we're going to have a V-shaped with quick recovery. 7% a W-shape with double dip plus recovery. 52% extended stagflationary period. 30% extended deep U-shape long recovery. I think all of those are legitimate answers, except for the first one. I don't believe we're in a V-shaped quick recovery. I don't see where the Fed's going to have the bullets, or we have the ability in the economy to backstop extended growth, especially in the service sector. And the manufacturing sector will fall off when consumers can stop buying, which looks like now, because we have 2 basically record months of consumer credit increases, leading to over $4.5 trillion of consumer debt. They're about tapped out. And with rising mortgage rates and rising prices, the real estate market has to have a pullback as well, at least enough of a pullback to clear out, to basically clear out some of the high prices, bring the price down where people can afford them. And if interest rates continue to rise, the values of homes and the market value of homes has to come down to maintain affordability. We know we're at the edge of affordability, so it has to come down. Doesn't mean that the real estate market's going to crash. It just has to correct. And it'll be one of the last ones to correct, I think, in this current recessionary period. Steve Wattis says, real estate prices stagnating, inventory rising in Toronto area seems recessionary to me. I agree with you. Peter Freund says, I think an L-shaped recovery by 2035. That could be true if we're going through the big currency reset. This could be a recession leading to the currency reset, or it could be a recession leading to a deflationary depression leading to the currency reset. We'll have to see what happens. Peter Freund said earlier, Rob, I hope you have solar. I think you'll need it this summer. I'm in an apartment, buddy, so I can't do solar. We're going to see what happens. I will say this, I have a much lower cost of living. That's good. So if energy prices go up, I can absorb it according to what I was paying last year. But in any case, and that's one of the things I took, is I decreased my lifestyle. Even though I have the money to live a much nicer lifestyle, I purposely decreased it for the expected price increases coming, because I don't want to lose my purchasing power in my future retirement. So I just said, you know what, I'm going to give up the big house, move into an apartment, have a little bit more fixed cost, a lot less variable costs, so that the variable costs I do get hit with, I'll be able to absorb without losing my purchasing power and losing my future retirement as well. Thank you, Rob Potts, for joining the program. Robert Booker for joining the program as well. I don't see any further questions, guys. I do not see any more super chats. Thank you, Dumb Money Media, for coming in with 2 super chats and your question. I appreciate it. I think we will hit recession as maybe quickly as the end of this quarter. We'll have to see what happens. That would be 2 consecutive quarters of declining GDP, which would signal a recession. I think the stock market said we're already there. The CFOs, who in this round of earnings reports reported lower earnings than expected, know what's coming. I think inflation's up and is going to stay up. And I think the bond rates rising puts incredible pressure on the government to pay their bills. The consumers are using their debt, so they're under incredible pressure to pay their bills. Lower labor force participation rate means less people working. That means government has to put more money out to keep the economy working. Rent's paid, food subsidized, all of those things that the government does, keep the defense up. So I think all the data I presented here shows exactly where we are. Now, in terms of mileposts or milestones, what happens next? What I've always supposed is we would have a sharp correction and one more melt up. I could be wrong. That could have been the melt up that leads to the Minsky moment, the crack up boom, whatever you want to call it. But I think we're going to have one more. I think what's going to happen is we're going to have deep recessionary pressures the last part of the year. The Fed's going to have to switch from tightening to easing. That'll include a crack up boom, a big explosion in the economy, and irrational exuberance, as they call it, where people go in for one last hurrah, not wanting the recession to come and not wanting the bad news that they're having right now. That'll lead to a pop in Bitcoin. That'll lead to a pop in most of the stock market indices. That will reduce some pressure on the bonds temporarily or cover up the problems in the debt markets. It may go on for, I don't know, 6 to 9 months, and then boom, we're going to have the waterfall off a cliff. That may occur 2023, 2024. It depends on how long the recession goes. And then the change in Fed policy, how long that takes to play out. If you look at previous periods, it may be like an 18-month cycle from here. We'll have to see what happens. That's by no means a guarantee, but I would suppose by no later in 2024, we're going to hit the really bad part of what has to be the clean out of the mess that is the economy. And that's my prediction. I've been saying that basically for the last 1.5 to 2 years. I'm gonna kind of stick with it. Timelines are very tricky, but I think we certainly see the milestones and how this is probably going to play out. Everybody, thank you so much for joining the program. This was Wall Street CFOs Predict 2023 Recession. Are they right? We examined the data and gave you a prediction for what we think is going to happen next. This piggybacked off a presentation I gave at conferences and on the channel called Gold and Silver. This time is different, where I looked specifically at stock market P&E values and called the stock market correction that we had this year, probably 2 or 3 months before it happened at a conference last September, I believe, Money, Metal, and Mines. So I'm doing pretty good on my calls. We'll see how those continue the rest of the year. Stay tuned to the channel. We broadcast from the great state of Texas, and we take no BS because we are gold, silver pros. Thank you, everybody. Until next time.